All right, hello, welcome. Josh Fuchs here, President of Obsidian Business Advisors. Welcome to today's training. We're going to cover merchant cash advance loans and revenue-based loans, which are pretty much the same, but there's some differences. And if you want to be very politically correct about it, you'll understand the differences and that they do have a different name. But as an industry, they're kind of lumped together, and you'll learn about that in the training video today. So we're breaking it into two different videos. I can be a little long-winded because I want to just provide information for you guys to learn this. And I have to realize that, I got to check myself sometimes based on timing. So I'm going to cover a lot of information in this video. We're going to keep it under an hour. Then I got a part two. So in this video, we're going to learn about the terminology, the types of loans, various types of loans and side loans. Because you got types, secured, unsecured, and then you got the actual types of funding available. So loan types and the types of funding, and then you got time frames. So where businesses fit into these loans, and these loans fit into time frame, short term, middle term, and long term, and some different unique factors from us, what makes us different here at Obsidian, and what the differences are, and a few other things. But the second video is how to sell these, how to differentiate yourself. I'm talking about some of that in this video, but repetition is a key to mother of retention, so we want to make sure that you actually retain a lot of this information. So I might repeat myself a little bit, but that is so I get through to you so that you're able to understand and go, wow, I get this, I could do this, and so that's important. But with that, let's flip on the slide PowerPoint here and get started. All right, so what we're going to be covering over the next few videos are definitions of loans and merchant cash advances versus ACH. Also, who qualifies, what it dictates in terms of a merchant cash advance or revenue loan, who can qualify for that. We're going to cover opportunity in sales and how to obtain more referral partners. So it's important that you guys watch the several videos that we've got that I'm putting in front of you, just because we're going to be breaking it down step by step and easy, cognitive bits or niblets for you to wrap your head around what it is. There is a lot of information, and so we don't want you getting frustrated rather than just plug and play. If you got to watch a video 3 or 4 times, they're short enough to do that. And we encourage you to take good notes, but watch these as often as you need to. If you don't watch it more than 3 times, you're probably not going to retain as much. And I know that sounds repetitive, but repetition is the mother of all retention. So you want to make sure that these are the things that all the videos that we've got for training talk about specific things. And one of the things that we do as a company that's very unique is we don't just offer merchant cash advance revenue-based loans. In fact, we're positioning ourselves to become a lender for those loans, to then explain to somebody, look, at the end of the day, we're a lender. We provide you with funding, and we've got a lot of other funding opportunities that help you. We're not going to keep you in a merchant cash advance loan. Our goal is to graduate you to better, more inexpensive funding by helping become and make you more bankable. So we are the stepping ladder to businesses becoming fully fundable. And it's our job and your job as affiliates to help paint that picture, to make sure they understand very clearly why we're different. We guarantee $100,000 for any business that, if you're offering merchant cash advances to businesses, which I recommend learning as much as you can, because it is considered easier. It's easier to get somebody funding. It's super fast. And the way we offer this to them is very unique, because we're getting them bridge loan. If you need money today, great, we've got the ability to do that. However, the money that you need tomorrow, we can do that too, all in the same transaction. We're going to build you up. We're going to make you bankable. We're guaranteeing you $100,000 or more for your business. If they do $100,000 a month in revenue, guaranteed we can do an additional $100,000 on top of their 100 in the various forms of funding. So we, as a potential future lender here in the very near future, we're going to be able to have full ability to underwrite these merchant cash advance loans the way that we want to. But you, as an affiliate, first must understand what these are, what kind of fundings we've got, and what are our overall services that we provide. So first off, it's understanding kind of what types of business loans are out there. Now, this is also in some of my other slides. Now, again, retention, right? I'm sneaking some of these things in to make sure you fully understand. Okay, so a secured loan. Secured loan is best for companies with property or assets to put up as collateral, and rates start as low as 5.99%. Now, a perfect example of a secured loan would be an automobile loan or a mortgage on a house, right? You go buy a house. The reason why they're able to give you a 3.9 or nowadays 2.5 to 3.5% interest rate is because it's secured by the house. Meaning if you default, they foreclose and get your house. They get the asset back. Secured loans are always going to be the lowest cost options out there. SBA is typically a secured loan. They want assets, and that's one of the major reasons why businesses cannot qualify for that, is because they don't have the assets to qualify. They don't have the profitability to potentially qualify either. Now, there's a list of 12 reasons why businesses do not qualify for all the various types of funding. Please be sure to watch that video after you complete the MCA Merchant Cash Advance Revenue Loan series of the few videos that we have here. It's important for you to understand, because you might ask during all these videos, why would somebody even want to utilize us? Well, there's 12 reasons why, and a very large portion of the businesses out there, 78% or more, face a lot of those challenges, and they don't know how to fix them, and that's what we do. So secured loans, we do those. We do all of these loans. Unsecured loans, these are popular. Why? Because any company that doesn't want to pledge any personal assets can do this. Now, some of the loan types that we're going to discuss are secured or unsecured, right? For example, we do real estate funding for investors. I'm licensed personally in 5 states. I cannot pay out on anybody that's doing an owner-occupied loan, but if they're doing a rental property, we can pay out on that. But anything that's like, for example, maybe somebody really just needs to consolidate debts, and the best options, they got plenty of equity in their house, and they're in one of the states that I can do loans in, we just get them a real estate mortgage, refinance, cash out, pay off all that debt. Now, why would we do that? Because it's going to put them in a stronger, better position. It's going to help clean up their credit. So I could say, hey, you do a refi with us here, I can waive the commitment fee, and because they're doing a mortgage with me, right? With Obsidian Business Advisors, we can actually turn around and get them their funding. They now pay for the credit restoration and all that fun stuff, credit edge, the $4,999, and then we start building their business up. Some of the debts that we pay down will help rise their credit scores. So there's always a method to our madness on what we do, but unsecured loans are what a merchant cash advance or a revenue-based loan is to an extent. It's unsecured, but it's secured by their revenue, right? But there's really if the revenue dies, so does the loan, right? So there's no recourse. Some of them have personal guarantees, some of them do not. Line of credit. This is best for all businesses. It's funding available for them at any time they need, and they only pay on what they borrow. You can physically have a line of credit with your bank or a lender or credit cards. Credit card is a line of credit. Credit card, a lot of people don't look at it like that, but what do? You have an available credit limit and then a balance. You can constantly use your credit card over and over again, can't you? As long as you're making the payments, as long as you pay it down, you can borrow it back. If you have a $1,000 credit card and you've got $500 on it, and you pay down $250 towards that balance, you now have $750 available credit to use. So there's a reward. It's constantly open, right? You can pay it down. You can, use it until you max it out, pay it down. We don't encourage anybody to ever max out their credit cards. In fact, if they can get a multitude of credit lines or credit cards, which is what we do. We get business owners multiple corporate credit cards. They're under their business. Some of them are the EIN. Some of them are under their personal credit score or the personal social security number. However, we do what's called credit card stacking. We stack all these cards and can get them a very large amount of money available. And then we say spread it out. Don't max out all your cards. Just spread them out. Keep below 30%, especially the ones that report on you personally. Always keep below a 30% balance. Never go over that, and always make sure you pay on time. Okay, so rates here can be as low as 6%. All of these rates vary depending on the type of loan that it is and the credit of the person that's doing it. Accounts receivable invoice factoring. This is where a lender will provide the business owner with a line of credit, kind of like what we just talked about, but it is 100% secured through your outstanding invoices, whereas like credit cards are unsecured. Okay, so that's where you can get confusing with the hybrids of some secured, some unsecured. So a lender provides a business owner with a line of credit. However, they control, aka the lender controls the line of credit. It's not like a credit card where I can just go into any store and just swipe and go, or write a check, right? I can't do that. I have to, as a business owner, and I want to pledge my invoices, I have to submit the lender several of my invoices. Let's say I've got 2 invoices for $5,000 each. Let's say I have 10 of those, but I need a quick 10, 15 grand. I can take my current invoices, okay? I can pledge it to the lender, and the lender will now give me the $10,000 that I need. So if I pledge 2 invoices at $5,000 each, they're going to transfer funds to me in 24 to 48 hours tops, and I'll have that $10,000, and that will go against my credit line. Okay, let's say I have a $20,000 credit line. I now have 50% usage, and I can only use the other 50%. So if I put in 2 more invoices without my invoices being paid by the customer, so let me bring this one up. Net terms, right? Net terms is the type of financing where a business owner will grant you a set amount of time to pay, 15 days, 30 days, or 60 days to pay your invoice for services rendered or the products that you've delivered to them. Meaning you have already provided the service or shipped the product to them. They now have so many days to pay you. Okay? You're giving them extended net terms. In a sense, you're granting them a line of credit as a business owner, okay, to then pay you on the credit line you've created for them based on your own money. You paid for the time, energy, payroll, staffing, product, whatever it is, to provide to that customer, okay? And then in return, they're going to pay you in 30 days. A good example of this would be commercial contractors, right? They're going to go into a restaurant and do a bunch of work. Maybe they're remodeling the restaurant, okay? Or maybe they're going in and they're just doing electrical work. They might be set up on net terms, right? That restaurant might be set up on net terms with their vendors for supplying the foods, the liquor, the food, all that stuff. They might have 30-day net terms to where they have to pay that payable. That's now a payable, right? If I owe somebody money, that's a payable. If somebody owes me money, that's an invoice. So these two work hand in hand. If you've got people that you're extending as a business owner net terms, you now can have an invoice factoring lender work with you to fund this. This is one of the things that we do, all this kind of funding. It's surprising to me that there are several companies out there that we've worked with, that I personally worked with, who never even, like, this saved their butt so much, and then I explained to them the benefits of this and why they never want to stop doing this. They're thinking the cost. The cost is less than a dang credit card. If you're a business, you're a merchant, and you want to accept credit cards, you're going to pay close to 3%. How many of you watching this that are affiliates, how many of you have been like charged 3% by your utility company? Power, water, sewer, garbage, whatever. Oh, there's a $3 convenience fee. Oh, okay. Well, that sucks. How do I get around it? Oh, well, you just mail your payment in. Well, I want to pay over the phone with a credit card. Okay, well then you gotta pay the convenience fee. There's no way around it. Sorry, ma'am or sir, that's just the only way to do it. What choice do you have? You don't really have a choice, right? So you do it. Well, with factoring, there is no 3%. It's 1.5, and they're mailing checks or doing ACH deposits. So the lender will give you the line of credit. They'll honor the fact that, hey, you're offering net terms. So when you offer net terms, one of the things that businesses should do that they do not, I'd say 85% of them don't do this, run credit checks on their businesses that they're extending their own credit to. Let's say I am business A, you're business B, and you want net terms. I need to run you through an application process and approve you. Guess how many people do that? Like I said, about 85+% of the businesses out there do not run a credit background check on that business or the owner, which means the owner could be very, very shady or inconsistent with pay. So they might be what's considered a late payer. They pay not in 30 days, but 90 days, which means they're now borrowing your time, energy, money, and efforts for 90 days without you paying, and they continue to keep doing that. So the benefit of having an invoice and factoring company that we provide is, one, you're going to get funding. This is one easy way to get funding that we can get these people set up with this in 2 weeks or less and help their business in so many different ways. Guarantee $100,000. We've got other types of funding that we can provide them. All these types of fundings we can provide them. They get in the capital edge. We're getting them bankable. The second thing is we now have an external provider for every new business that they're looking to extend at terms. They now have an external credit department that will run. They say, okay, great, fill out this app. They fill out the app. They forward the app once they get it back to their now external invoice factoring lender. They will underwrite that customer for free and say they're creditworthy or they're not. That now tells you as the business owner, sorry, I can only do, you were declined, so it's only cash. You got to pay us at the time of service or at the time of purchasing our product. It saves the business so much nightmares for accounting and cash flow problems. The other benefit is that they also will act as your free collection company. Let me rephrase that. Collections of the invoices. I don't know how many times I've seen businesses that have net 120 late, like 120-day lates and longer, and they're still giving them new invoices. It's like, whoa, 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 whoa. If they've got a credit line, you approve it for $10,000, which a lot of people don't even do. Remember, it goes back to the 80+% business owners don't extend credit. Okay. They just say, yeah, you get net 30, but they don't attach a line of credit to it. See, these lenders attach a line of credit based on your total invoice average. If you're averaging $100,000 in invoices a month, they're probably going to give you between 80 and 100% of your invoice average as a line of credit. Now that can grow as you grow your business, but it and the way I'm explaining this is that I want you guys to understand that these are all various types of different ways businesses can be funded and how we bring value. What if somebody's already doing this? Great, we're going to ask them how they like it. We ask them on the application process, do you factor your invoices? If so, who do you use? Are you happy with them? Same with their credit card processing. Who do you use? Are you happy with them? If they say no, that's a really good way for us to go, awesome, because we've got some really, really great opportunities that we want to be able to present to you to be able to see if we can save you money and add more value so that you love the services that you're getting. This one's a big one. We've got a company that we partner with, and we send them a lot of our business here, specifically because of how amazing they are. They're very communicative. They're extremely good. Their pockets are super deep, meaning they're very well funded. You can get credit lines to 10, 15, $20 million with this lender easily. And we partner with them pretty extensively to where we're now referring people back and forth. So We do all the heavy lifting, right? We underwrite, we make sure that they're, our approval success rate is pretty darn high, 95+%. So that's why we can guarantee $100,000 in funding. Does this count towards 100 grand? Absolutely. Everything you see on here does. Okay. So equipment loans, last one. These are loans that are made based on specific equipment, where the equipment becomes a collateral, kind of like the house or the mortgage or the car loan. See, if any business owner wants to take advantage of tax law, then and they want to be able to not have vehicles show up on their personal credit, they need to get an equipment loan under the business so that when they take out the loan, it's now under the company. So they get a lot more tax deductions. The rate might be just slightly higher than they would if they went to a dealer. You can still go to a dealer and say, look, I got equipment financing in place. I want to buy this car. I already am approved. Boom. It's like buying for cash. They don't have to deal with anything. You just show them your approval. So a lot of the times, we'll need an invoice from, let's say you're looking at buying 2 delivery vans, right? Let's say you're a restaurant and you do catering and you need catering vans and you want them wrapped and racked for all the food and everything, right? Well, you wouldn't want to put the vans under your name, right? You'd want to put it under your business. What if you need a big truck, right? Let's say you do contracting and you're a contractor and you've got vans for service or whatever, but you just want a really nice brand new 2020 Dodge or whatever it is with a lift kit, and you just want to have let me phrase it here, don't take this wrong, a badass truck. Well, don't buy it personally. Put it under the business. You're going to get the cost of that vehicle is going to go down. We're going to be able to get you that $70,000 truck loan is not going to go under you personally. It's not going to jack up your personal credit. Trust me, $70,000 truck loan will drop your score 50 points easy until you have an established payment history of about 12 months on it. Good payment history. Put it on the business. So a business owner can now get an equipment loan. It's a 5-year payback. Okay. There are things we do nobody else does. Purchase protection. We can now say, hey, we talk to our lenders. We got a couple lenders that are open to this. We now get that invoice, right? We get the invoice, and then we have our own invoice, which is combined purchase protection for the loan, right? So the lender's going to lend 70 grand plus the purchase protection amount. Why would they do that? Well, they're now guaranteed to get 100% of their money back, whether the person defaults or does not. With businesses, it's a little bit more risky if there's no personal guarantee, simply because of the fact that, one, it's going under your EIN, which establishes a trade line for the business owner. 2, it makes it to where the business owner, if they just file a Chapter 11 and go bankrupt or whatever that looks like, the equipment will typically go back to the lender, but the lender has protection. They've got the ability to go after the equipment because it's secured and collateralized. But now they've got this, think of it like a life insurance policy. They've got a policy, it's a financial product, but let's just use this as an example. They've got a policy wrapped around their loan, and it guarantees to pay back dollar for dollar of their loan, right? So if they default, because the lender's the beneficiary, they now get all of that money. If they don't default, at the end of 5 years, the customer gets a percentage of that, meaning they're going to get a cash rebate back on their purchase, 45% cash rebate. Our loan program that we created, called the Sharpest Edge Funding Program, is based off of equipment loans. We do the exact same thing. It's built in, but it's on IT equipment. Why? Because our IT provider will give us 50% rebate, cash to the business owner. Because computers could have all kinds of, first off, it's the one thing every business needs. You got to have a computer to operate, period. So we focused on that. Now, I'm not going to dive into that, but be sure to watch that video because it's a pretty cool program and it's based on equipment funding. Why? Because this is probably, these two right here, probably the most powerful fundings that a business can get that's not utilized near as much, in my opinion. We could finance $5, $10, $15 million in equipment. We can do $5, $10, $15 million lines of credit. Now, with accounts receivable, they're going to have a minimum, right? They're going to say, look, we're giving you $100,000 line of credit. You need to at least fund $20,000 minimum a month with us. Meaning you have to borrow and use $20,000. That's 20% of your line of credit, right? The lender will, based on the risk and what they see, they're going to set that limitation, that minimum requirement, right? All it does is it covers the cost of them allocating those funds. If I create a line of credit for you, I have to make sure I've got the money to set aside in a dedicated account so that it doesn't get spent. So when you say, hey, I need 50 grand, oh crap, I just lent it to somebody else. Sorry. No, it has to go into an account and sits there for you. So they're moving $100,000 for the business owner in a line of credit. That has a cost. The $20,000 minimum or the 20% minimum covers their cost. They can justify it. Say, hey, as long as you're doing $20,000 with us, we're cool with keeping that $100,000 line of credit. Okay, these are typically 12-month terms and can be auto extended pretty easily. So I think these are very underutilized options. Now, what are the types of business loans? Again, these are options that we just kind of covered. And now I want to talk about funding types by timeline. Short-term funding, medium, and long-term funding options. Short-term funding is 3 to 15 months. Okay, so this is short-term. Merchant cash advances and ACH revenue-based working loans. Okay, these are, we're going to talk about this. This stems from credit card processing. This is from overall monthly deposits. These are all short-term funding options, 3 to 15 months. And they're the most expensive. Why? Because they're short term. They're super available and they're easier to qualify for. Medium term funding options are 15 months to 60 months. So 15 months to 5 years. Working capital lines of credit, business and personal term loans, business and personal credit cards, receivable funding credit lines. These are all more like medium term options. Now with credit cards, there's no real expiration date on them. So technically they could be more of a long term play. But there's ways for you to get your lines increased and things like that. These are things we actually do. So make sure that you guys, I just want to make sure you guys understand some of the difference. Again, medium term, this is in general, like working capital lines, personal loan, anything under 60 months, some of these can be considered long term, right? 60 plus months. Equipment financing is usually 5 years. So that could be probably more of a medium term, but you could also go to 7 years. That example that I gave you about the vans, delivery vans, here's the great thing about equipment financing. If I'm a restaurant and I want a catering service, I need to get my van wrapped. I need to put nice wheels and tires on it, tint the windows. I got to put racking in it to hold all the different variable foods and things for what we're doing and how we want to set that up. All of that is included in the financing. So you provide us, whether you do it through the dealer, the business does it through the dealer, or they have individual invoices for each one of those things. They would send us all of those invoices and we would get them an approval for funding in the amount of what the total is for all of that. 100% financing on all of it. That means they don't put any money down. There's no performance fee from us on equipment financing. We can't do it. It's not that it's illegal. It's just we're now charging them money for something that's 100% financing. No, we're good. We get paid by the lender, and that's how we're able to pay your guys' points out. So our sharpest edge funding is based on equipment financing, so it's 60 plus months. So it's 5 to 7 years. SBA funding, 10 years, 20 years. SBA Expresses are 3 years. So SBA Express should be more of a medium-term funding option, right? So apologies for not having that in there. But SBA is also one of the hardest to get because of anything over $15,000 has to be secured. It's between 15 and 25,000. After that, you got to have it secured. So most businesses need to have assets, right? Now let's talk about what a merchant cash advance loan actually is. It's an advance of a business credit card sales. So I want you to look at this here. Customer, okay, we're going to use an e-commerce customer. So these customers are going to an online website, which is the merchant. They manually enter their credit card information on their website. The processor, the merchant credit card processor, processes that transaction, okay, and it settles out the merchant to their bank account. Now that's the normal process. Now when you have a lender, the lender's going to say, hey, on this e-commerce company, they process $100,000 per month on average over the last 6 months. We can typically fund them 80 to 120% of their monthly revenues. I know this says 100%, but we could particularly go up to 120, okay, and fund them in 3 to 5 days. So it's super fast, right? We give them 100 grand, and then they're going to pay what's called a flat payback or a factor, right? So we're going to say you're going to have to pay a 1.35 factor rate, which means they borrow 100, they pay back 135,000. What's going to happen is the flow is going to be a little bit different. Customer goes to the website, they check out, the processor processes that transaction. 85% of the funds is going to go to the merchant bank account for the merchant. The 15% will be siphoned off to the lender to pay back the $135,000. So they're taking roughly 12 to 15% of the daily batches. So every day, customers are going to the website, right? They're buying out. They're buying product or services. That processor batches those payments out to the merchant bank account, right, to deposit it. The merchant receives 85% of that, and the other 15 goes to the lender, which automatically reduces the balance. So the merchant, let's say their average ticket's $100. They're going to get 85 bucks, and the lender takes 15, and they deduct that from the 135 over time. So these are short term. So they're going to be 4 months to 18 months. A lot of the time, you're going to see it less than 12 months. You're going to see 6 to 10 months on average is what these do. Now, what's an ACH revenue working capital loan? It's dang near the same as a merchant cash advance, and a lot of people just call these both merchant cash advances or MCA loans. But they're different, okay? They're the same, but they're different. One is e-commerce. They do everything. All of their revenue is online, right? So they do 100% credit card sales. They don't really take cash, and they don't take check, and they don't take ACH, and they don't take wires, right? So they're a perfect MCA customer because they do a lot of credit card volume. ACH revenue-based loans were created because the lenders were like, man, we're missing a lot of opportunity. We're missing a ton of different industries that we could help provide funding for and make a lot of money doing it, because these are probably the most expensive loans you can get because of their availability, right? The rule of thumb is the more available it is, the more expensive it becomes, meaning the easier it is to qualify for, the higher cost it's going to be. So a revenue-based loan is based off their total deposits. So look at this picture here, and I know it's kind of a crappy photo, so bear with me. But you're now able to get funding based off of all your invoices, all your cash, credit cards, ACH, deposits, cash, everything. So a contractor company might process $30,000 a month of credit cards, $65,000 per month in financing because they offer financing to their customers. They can upsell, get a bigger average ticket. That gets deposited, right? And then another $65,000 per month for checks and cash on delivery. So this company that is doing $160,000 a monthly sales would only be able to get $30,000 with a traditional merchant cash advance. Well, with an ACH loan, revenue loan, or you're going to hear this phrase a lot, merchant cash advances. They're just lumping these in there, but I'm teaching you the realistic definition of what these loans are. A ACH-based revenue loan Working capital loan is exactly this. It is not a merchant cash advance, but they are lumped. A lot of companies lump them together as one, but there is a definite definition of the two that are very different. With an ACH loan, they're now able to get up to $160,000 or 100% of all of their various deposit options because it's based off of their total revenue and total deposits. So think about that. This contractor company with just a traditional ACH would only get $30,000. But because lenders said, you know what, no, that's stupid. We need to actually open this up for all of their revenue and look at their various forms of funding and make it on their deposits, not on their credit card sales, because those are included. Remember, a credit card processor batches out every day there's a transaction. That becomes a deposit. So they now say, hey, we're going to base this off of if you've got 10 deposits a month and you do X amount of dollars, $15,000 or more, great, we're going to be able to loan you money. And what they do, how do they collect their money? Instead of paying back from credit card sales, they just ACH their bank account every day so that the business owner is making micro loan payments back on a daily basis, Monday through Friday during business banking hours, right? So the good rule of thumb is 20 days a month, they're making a micro loan. So for example, they have a $160,000, let's use this example here. They have a $160,000 loan, and let's just say it's at a 1.13. So I take that and I times it by 30%, right, which is, I believe, 48 grand. Yep. So now they're paying 160 plus $48,000, so $208,000 payback. It's for 10 months. So I take the total payback and I divide it by 10 months, which is $20,800 a month. Then I take that number and divide it by 20 days. This particular contractor would be paying $1,040 a day. Geez, Josh, that's a ton of money. It is. It is. But what did they use the 160 for? I'm going to give you an example. This is like real because we specialize in contracting companies, and so I know this industry really, really well. So any of you that want to pick a niche, contractors are great because they come in various sizes and shapes, and you know the decent ones do hundreds of thousands of dollars a month, and they need capital too. But with our spin and our twist of what we do to help them, I mean, we've already done it. It's massive, but there are a lot of other businesses out there that are not in that industry that need our help. So with that being said, this is a real scenario that I'm giving you. This is an actual previous client. So the 160,000 they're able to get, we used about $85,000 of this to pay down a bunch of debts, right? Actually, I take it back. It was like 100 grand, 110 grand. We paid $80,000 in all the debts that this gentleman had. Paid down $80,000 worth of debts to get him below the 20% utilization ratio. Got him in credit restoration. Started looking at his business credit. Realized that he's got a bunch of vendors that he's got rolling 60-day late payments on. That's a huge no-no when you're trying to improve your business credit. So we went in, paid off those vendors, took the other $80,000, paid those vendors. We paid several of the smaller ones off, and the big ones we paid way down, got him caught up, and then made sure he was able to continue to pay on those so that he's no longer late, right? When they give you net terms, think of it like an American Express card. You got to pay the whole balance off. There is no ability to pay it like a credit card unless you got a credit card. So what we did is we paid down a lot of his credit cards, paid off his outstanding balances due for a lot of his vendors to get him current, and then started focusing on keeping him that way. So as revenues came in, immediately paying, we're like, hey, you got to immediately pay those off, keep those down, because in 60 days, we're going to be able to get you a bunch of funding that's super inexpensive, but you're going to have to carry this $1,000+ a day, right? He's paying out $1,040 a day. So at first it wasn't a big deal, right? And a lot of the times companies can handle this. They're basically using some of the money that they got to cover the payments, which we budgeted in as well. We know that on average it's going to take 90 days to 120 days, so 3 to 4 months max. So our goal is to get them to, if we can budget in at least 60 days worth of payments from the money that they're borrowing, at best, right? Worst case scenario, we don't. We put all of it towards marketing and just make sure that the marketing is a reputable marketing company that guarantees results if it's something they're asking for our referral, which we love to do. It's vital. There are several key elements of what they want to invest in. One is marketing. Always, always pay for marketing. If somebody calls us up and says, hey, I'd like to get funding so I can make payroll. Sorry. What do you mean you want to borrow expensive money to pay payroll? Well, I got to pay my employees. Yeah, okay, well, why don't you get money and that's just, there's no return on investment there. Well, if they're like, no, I spent a whole bunch of money on marketing and we're waiting for it to kick in and I need to borrow money to turn around and make my payroll, then we were going to want to see some stuff from them regarding their marketing. We want to know that they did do that. Because here's what a lot of other businesses in this space do. They focus on merchant cash advance revenue loans. They don't care if they put somebody in a bad loan and the company goes out of business. They're doing so much volume, they don't care about the company. Their biggest thing is they get a reminder in 6 months to call the company and say, hey, you're on a 12-month loan. You're now 50% paid off. How'd you like to renew? That's all they care about, renewals. We don't renew people in merchant cash advance loans unless we absolutely have to because they need a little bit more time and a little bit more money. Renewals are not good, and we're going to talk more about that here in a sec. So I want to make sure you guys have an understanding between the difference of a merchant cash advance and an ACH revenue working loan. Merchant cash advance, what is syndication? Okay, there's a lot of companies out there that will lie and say they're a lender. They're just a broker. They literally, in a sense, just sell the funding. Some of them don't even do it ethically. They push funds, expensive funds, onto somebody that doesn't need it. Our model is we want to make sure that the cost is below the benefit. Benefit outweighs the cost, right? So what they do is they'll syndicate. They will be resellers or brokers. They'll partner with funding providers, and they'll basically be offered the ability to pool funds, right? So let's say Obsidian Business Advisors wanted to syndicate with one of our lenders. They're always saying, hey, why don't you, we open the door to you that anytime you want to invest on one of your deals, you could become a part lender in the deal. You could put 5,000, 10,000, whatever it is, whatever percentage above 10% into the deal that you're funding, they allow you to do that. These guys now call them a direct lender. 100%. See, what we're looking at is becoming a direct lender where we actually get a line of credit from one of our lenders. They're like, here, you guys, we like your system, we like your process. Here's a line of credit. You can pull from it, loan. Here's the guidelines that you have to arrange. Now you've got a line of credit. Now you can fund. We're actually funding businesses. We're now the lender. We are a legit lender. We are not a syndicator. Okay? So I know that's a little confusing because, well, Obsidian's not using their own money. No, we've got a line of credit. It's just like if I went to the bank and got a business line of credit. That's the business's money. They're now lending their own money. We're now lending our own money. And that's where we're going with this, is we're getting in a position to be able to do that. But we only work, just so you guys know, the reason why I bring this up, we directly work with lenders, not syndicators or brokers. 100% lenders. Every year that I've been in this, I see more broker jokers out there that pretend to be lenders so that they can get massive amounts of what's called ISOs, independent sales organization. It's a fancier word for an affiliate. Okay? There's a little bit more involved. You're responsible for your own marketing. You might make a little bit more money, but you got a lot more things to do. Like you're underwriting, you're doing everything, right? So they lie to people to bring in people. I'm telling you right now, as this being an affiliate training, we are becoming a lender but at the same time, we are direct to every lender we work with. We will not, when the money goes out, it comes from our lender, from their name, it is out of their account. We work directly with every underwriting department for every lender that has, by the way, when I pre-qualify each lender to work with, they have to have over $100 million in money, capital, to be able to qualify. I don't just accept every business. There's so many lenders out there that, what's the point of having 500 lenders when you're juggling a bunch of clients and a bunch of lenders? People ask, well, wasn't it better to shop us out? They're all the same. They're pretty much all the same. There's no real difference over one lender versus another, with the exception of some of them that they specialize in higher risk. We have those too. So for example, a contractor is considered higher risk. I might have one lender that's a little bit more favorable of a contractor, because that's what they do. They do higher risk. Some of them that do high risk charge a lot more, but they're like, hey, it's high risk, this is what we've got. So again, it really just depends on the business type and the lender and what they specialize in. Because sometimes lenders have really good rates, and they only work with certain businesses. So what we do is we partner with the right ones that are very well funded. They've got their own systems. They've got API integration, so we can integrate our systems into it for streamlining the funding process and make it faster. That's what we look for. We're direct to everyone that strokes the check. So what does it take to qualify for these loans? Why are they considered low-hanging fruit if that's the case? First off, I want you to know that over 75% of all the funding out there right now for businesses is this type of funding. Merchant cash advance revenue loans, because there's that many businesses out there that need the Capital Edge program. I am not kidding. It's massive. Yeah, you're going to have that other 15+% that's doing real well, but you're also talking about a lot of companies that have a lot more. They've been around longer. They've got a lot more revenue, 10 million, 15, 20, 30 million. Our sweet spot, by the way, is $500,000 to $5 million. That's our sweet spot. That is where we get a ton of business. And that's where 80+%, 78 to 80% of all businesses right now are getting these types of loans. Why us? Because we get them out of these. We show them what it's like to be bankable. You want to have aspirations to be a big dog. You want to be one of the big businesses. You want to grow this to 5 million, 10 million, 20 million a year. You're going to need the right funding. Instead of paying $1,000 a day, what if I got you $250,000 and you're paying $1,500 a month? That's going to change some things, don't you think? Need to be in business actively for 1 year or longer. You must have $15,000 or more in monthly revenues consistently for the past 4 to 6 months. You must have a FICO score greater than 500. And can't have any more than 3 non-sufficient funds in the last 30 days, and no more than 6 non-sufficient funds in the last 3 months. Basically, if they've got negative days in their bank account, the lenders don't like that. They don't like that at all. And with our new program, we're going to mimic a good chunk of this stuff. But what we might do, because we're creative, is we add a little bit more to the points, and we build in our actual, here's a really cool part, we actually build in our Credit Edge fee. So we get it all up front. They don't even know about it. It's part of their payback loan. That's something that we're going to be able to do potentially, that I think is going to be game changing for us and really beneficial for the business owners. So with that being said, we're looking at options. Stay tuned for that. We'll have another video training on that. But this is what it takes for somebody to qualify for a revenue loan. Now, again, I want to go back to the iteration about outcomes higher than cost. And in our next video training, because I know this is getting a little bit longer now, we're going to cover this again. Outcome, or the benefit, is higher than the cost. Merchant cash advance revenue-based loans are very expensive. Between 30 and 45 cents on the dollar. Some people consider that predatory lending. It's not predatory, or would not be allowed. I can tell you that much. It is the available cost of funding. If I, a personal business owner, wanted to loan you money and you needed it yesterday, and I negotiated 50% payback with you, and you said, yeah, I want to borrow 100 grand, I'll pay $150,000 back in X amount of time. I could do that. Why? Because we just agreed to doing it. And one of the things I want to iterate is that this industry is not licensed. So it's private investors just putting up their own money. Now, some of these private investors are very big corporations that now pledge. They don't have to have a lender license in a state to do it because they're not selling you an interest rate. Remember how I said it's pennies on the dollar? It's called a factor rate. They factor in the cost of the loan into the payback. That's a good way to think about it. They factor in the cost of the loan into the total payback, and they have you pay it back over a specific amount of time, and they collect daily. So as you're factoring, think of it like a receivable factor, right? They're doing what? They're charging 1.5% thereabouts, up to 2.5% per invoice. There's no interest rate. They're not borrowing a line of credit at 8%. They're getting a line of credit with no interest attached to it, and then they're paying per invoice that they fund. So it's important you guys understand that these are high-cost loans. This is something, well, why are you telling us to sell this, Joshua? I'm just telling you that this is where most of our clients are going to get the benefit, and because we offer a Tier 3 no commitment deposit option for them, this is the no-brainer solution. They need our help. They're getting this loan with or without us. They might as well get it through us, and then we create a map, a massive action profit plan to put them into outweighing the facts of, let's say we get them in a 6-month to 8-month term, right? They got 8 months to pay this back. By month 2 or 3, we want to be able to start getting them other types of cash. So when they pay this off, they don't need money. We've got them a whole bunch of extra cash, and it's a lot less expensive. They're now in a super strong position 90 days later to 120 days later than they ever were with any of these other people because of what we're able to do for them. Now, we can help customers pay down personal business debts. So that, what is it that makes us better? What can we do with them? Why is this better? Okay, let's go through this. Excuse me. Somebody gets funding. Okay, let's go back to that contractor. 160 grand. We're paying down personal debts. We're improving and cleaning his personal credit. We're building his corporate credit. And how are we building his corporate credit? Well, some of those credit cards we're able to get him were under the EIN. Once we got his scores where he needed to, we were able to get him 2 more vans for 2 more technicians. Okay, that went under his, you got it. We bought them separately, not together as one, so that he has 2 separate loans reporting under his corporate credit as EIN. Guess what that does? Drastically builds his corporate credit. Then we started getting him more and more funding. So by the time he was done paying this off, he'd already had a $100,000 guarantee that we already hit pretty easily. And that's not including the $160,000 we already got him. So he got almost 300 grand from us, over 300 grand from us, and it was in 90 days. That's what we do. We map this out. We want to just say, hey, here's the things we're going to do. Not to mention that he didn't have any marketing issues, but if this were another company, we would have pressed the marketing. He needed technicians. He needed vans to get people in, and he needed money to pay down his debts because he was way behind on bills. We got him all caught up. We got him fixed. We got his credit score screwed through the roof. He went from a 640 to a 745 in 30 days. Phenomenal, huh? This is the stuff that we do. That's the result. They get more funding for a lot less, very fast. Their credit is improved. Saves them on all other forms of financing. Saves them on insurance costs. This guy's insurance, I was like, get your insurance ran. Go back and get your insurance ran. So all of his vehicle insurance, all of his commercial insurance, his all of that stuff was based off of credit score. He got at least another $15,000 a year in savings just by getting his insurance policies redone. We helped them budget out some of the funds to put towards marketing again, yield them results. So it happens to be a very beneficial if somebody has a map, a game plan. What's going to happen? Here's your massive action profit plan. Why do we call it a massive action profit plan? because we're using the funds to get you in a more profitable state with best funding options, which keeps your costs down. If you're paying $1,000 a day versus $1,000, $1,500, $2,000 a month, and you got more money from that $1,500 a month, it's a no-brainer. It's all about cash flow. Now, here's a quick tip going into our next segment. Going after marketing companies who specialize in specific niche market that you're focusing on is a dang good way to help, one, Obsidian business advisors create a relationship with them to refer to other businesses, but also a good way to get you a second tier business underneath you that's referring all these businesses to us. Meaning you sign them up underneath you because we're a two-tier affiliate program. Now you have a marketing company sending us money, sending us clients to get money. Why? Because we're getting the customer funding to turn around and pay the marketing company for their services. So when they have an objection, oh, I can't afford your marketing, I don't have 15 grand. Okay, great. Well, how much do you make a month? Well, we make $30,000 a month. Great. We can get you funding for that. Really? Yeah. Plus, the company we partnered with is amazing. They're going to help you become bankable, so that you don't have to worry about saying that to us ever again. And they'll get you the funding above and beyond what you need to be able to make things happen in your business besides just the marketing. Oh, that's fantastic. Yeah, let me send you the link. They send their affiliate link. Guess what? You as a sponsoring affiliate get an override off of what they produce. So it's brilliant, right? It works out very well. So anyways, with that, I am going to say thank you. Please plug into the next video of how to sell merchant cash advances and the Capital Edge program. And we'll just continue to keep building upon this and adding one video at a time so that you guys have a full understanding of all the various aspects of commercial financing and how to maximize your commissions with Obsidian Business Advisors. Make it a great day.